We have everything set up as current events. We now have a brand new blackboard. I have my notebook ready. And we will begin. So, today we'll be covering both, so for current events, we will be covering both September 11th and 12th. So we'll be doing both days in one day since the stream was down yesterday for all these awesome improvements. Let me know if the sound is okay, if you guys can see what I'm writing on the board. Just want to make sure everything is enough, okay? Maybe not, we'll see. All right, so our first story is, or has to do with investor confidence. Investor confidence. I'm going to have to get used to this shorter board. Investor confidence, right? So that's usually an important thing to monitor because investor confidence decides how much or how little money they decide to keep in the market, right? So investor confidence can be very, very, very important, right? And so our first story covers the following. Consumer indicators are very good, right? Consumer indicators are very positive. And usually, this is a good thing for the market, right? So consumer indicators consist of things like job growth. So if the number of jobs in the economy is increasing, job growth is positive. The second thing that it consists of is wages. Wages, right? So if wages are increasing, this is another positive. So job growth is viewed as positive. Wages are viewed as positive, right? The third thing is spending. If people are spending more of their income, that means they are confident in the economy, right? They're confident in the future, and therefore that's a big plus. And then finally, and perhaps a little counterintuitively, we have manufacturing. I'm going to have to get used to writing with chalk, so bear with me. I'll be a little bit slower on the writing. Let me just double check everybody can see everything okay. Audio is 5 times 5. I'm not sure what that means, but it sounds like it's a good thing. Nice audio quality. That's what I like to hear. That was one of the two big improvements that we really wanted to get through. So, investor confidence. I do want to make sure if you guys get a chance, can you guys see what's on the board pretty clearly? If not, that's something else I'll have to work on. So, here's the good thing, right? The good thing is there's a strong correlation, strong positive correlation, right, between consumer confidence and consumer indicators and market growth. But here's the bad thing. Investors very rarely think that things will change, right? So they very rarely look at the current market conditions and decide, well, things are going well now, but they're going to get worse. As a matter of fact, investors are pretty good at short-term thinking, right? So if this is the trend going up to today, right, that's today, investors will often look at this trend and say, well, this is the likely future, right? Very rarely will they look at this trend and decide that we're actually going to go down. And so when you have more and more positive things lining up, people tend to get concerned that eventually something has to break, right? Eventually something has to go wrong, right? And you can say these are like, doomsayers or, people that have generally pessimistic outlook, but the reality is nothing is good forever, right? So one of the things that's important, right, and one of the things I didn't cover, so that's where investor confidence is. And this article kind of warns that this is difficult, right? But I'd like to talk a little bit more about manufacturing. right? And the reason I'd like to talk a little bit more about manufacturing is it's not often thought about as a good consumer indicator, right? Or it's not often even considered as a consumer indicator if you were to look at something like that, right? So what manufacturing does, manufacturing has lead time. So the indicator for increasing or decreasing manufacturing has what is called lead time. And the reason is, no matter what you buy, it was made at some time in the past, right? So no matter what you're buying, no matter what you're getting, it was made at some past time, right? So let's call that t minus 1, right? Currently, when you're buying it, you're at time t, right? So manufacturing, the indicator measures at time t. And what it says is it says that manufacturing is increasing currently. It could say that it's decreasing. But manufacturing is increasing for time t plus 1. And what this indicates is that manufacturers, firms, right? So if you think about it this way, right? You very rarely buy directly from a manufacturer, right? Unless you're a business or you're buying things from a farm, you're very rarely buying directly from a manufacturer, right? So you have a factory, right, that produces a bunch of smoke. And then you have a retail store, right, with doors and windows and so on and so forth, right? And then you have the consumer. And then you have the consumer, right? And the consumer is looking to buy something from the store. Now, if the store anticipates that consumers will keep spending money, then the store then, in turn, places larger orders with manufacturing. And manufacturing then, in turn, continues to produce, right? Now, this is why manufacturing is considered an early indicator. So if consumers are starting to buy less, stores will start seeing a slowdown. If stores start seeing a slowdown, then manufacturing starts seeing a slowdown, right? And manufacturing will be one of the first indicators that things are going south, right? Now, we'll talk about in the future about the different components of that that could affect it. And one of the things that it's important to consider is that, it could be materials prices, it could be a lot of things. But in general, as long as consumers keep spending, stores will keep buying, and manufacturers will keep increasing their capacity. So the article warns that perhaps there are starting to be too many good indicators, right? Jobs growth is happening, everything is happening, but that's not necessarily the case, right? I mean, here's the thing. You could publish that story almost every single week during a growth phase, and eventually you will be right. No doubt. Eventually you will be right. There's no way that things could go on good forever, but it's not good. The next thing we can move on to is developing world markets. Markets. Right? So developing markets are generally markets that used to be considered third world countries. They used to be called a bunch of different things, but in general, right, they're markets that don't have systems that are as developed in terms of institutions, right? And these include both private and public institutions, right? And importantly, in the sense of developing markets, they tend to rely on most of their capital, right? So if this is a developing market, they tend to rely on most of their capital from outside funding, right? So other countries investing in the country, rather than relying on capital from internal funding, which is what developed nations tend to do, right? So the story here is the following. Now, we've discussed in recent news that developing markets have been in decline. And one of the reasons they've been in decline is because interest rates are rising. Increasing interest in developed nations. And increasing interest in developed nations leads to a stronger dollar, right? Or stronger dominant currency. Now, this article indicates that a lot of developing nations are having trouble borrowing. And the reason is the following. If most of your funding is coming from abroad, right, let's say from the United States, from the EU, and the interest rate in those countries is rising, investors would much rather keep their money safe than take additional risk. So you need to compensate them for additional risk by either borrowing less, so reaching out to to smaller investors that can perhaps bear or are looking for more risk, and paying higher interest. Paying higher interest. And now the reason that they're having trouble borrowing is the following. They can't borrow less because all of those economies were just growing recently, right? So they're all growing, they're all in an expansion cycle, so there's a lot of good opportunities, people are investing, right? And it's difficult for them to pay more interest. And the reason is, as the dollar strengthens, when they have to pay back dollars, they have to use their currency to pay it back, right? And that's quite difficult. So, the consensus on this, or so far what analysts think, is that perhaps if this only lasts until the end of the year, firms can ride it out, right? We're looking at a couple of months, usually slower months, right, because of the holiday season and so on and so forth. So maybe they can ride it out. But if it lasts any longer, it's going to lead to a credit crunch, where investors don't have enough money, or companies don't have enough money to be investing in valuable projects. The next article is concerned with the end of oil. End of oil, and importantly, not oil altogether, but oil growth. Right? So as you can imagine, the general trajectory for oil, with ups and downs, right? So if this is quantity and this is time, right? The general trajectory for oil ever since it's been found, to be as useful as it is, has been up, right? However, people are predicting that trend will end in 2023. And there's a couple of reasons for that, right? The first reason is renewable sources are getting cheaper. Renewables are cheaper, right? So things like wind and solar are going down in price. The second thing that we're finding out is that there is a big international push to move to renewables even if it costs more, right? And so the interesting thing that's happening is investors are demanding, right? So if you're not invested in the market, if you don't invest regularly, right? If you don't have holdings in things like Exxon and stuff like that, and I would be sure that you do, because a lot of 401ks and a lot of retirement plans do invest in those companies, right? So if you don't have holdings in those companies, you might think, well, too bad for them. They'll go, the other way, and new companies will take over. But investors are invested in these companies, and what they're demanding is, what are you going to do? What are your plans, right? How are you going to adapt to this new landscape? Because Exxon has a lot of money, and they're not satisfied with Exxon just disappearing. They want Exxon in the renewable game. And Exxon has been investing, as has BP and several other companies. They've been investing in these renewable sources. So that's a story we're going to continue to follow, probably for the foreseeable future, right? Definitely into 2023, probably after that as well. But the reality is, some analysts say it's even earlier, right? Oil companies obviously say it's going to be later than that. But there will come a time when the amount of oil peaks. And when it does, that's different, of course, than peak oil, right? Don't get those two confused. Peak oil was the idea that there's not enough oil to go around, right? This is slightly different, where we're talking about just the demand for oil declining, right? Okay, this one just caught my attention because of the high-profile name. William Wrigley Jr., excuse me, with a W, Wrigley Jr., who many of you might have heard about as Wrigley's Gum. That little 30-cent pack of gum used to be 25 cents, was 10 cents before that, or a nickel, right? William Wrigley Jr. has invested in a marijuana startup. Now, this caught my attention for two reasons, and I bring it up only for two reasons, really. One, marijuana startups and marijuana companies have been receiving a lot of attention, and for good reason, right? Marijuana is used across cultures and by many people. It's generally more difficult to access now than when it's legalized, and so the current trend is for decriminalization and eventually total deregulation, or not deregulation, excuse me, but total legalization, right? But interestingly, so there's been a lot of marijuana startups, there's been a lot of companies that are developing new strains and new methods of distribution and so on and so forth. But this company won their investors' bid by focusing on health and wellness. And this is very interesting, right? Because this is actually the lower risk scenario, right? So before we see full out legalization, we're going to see a push towards health and wellness, right? And that's been a lot of the driving force behind legalization, right? So health and wellness is going to be the focus, right? And the company that they invested in specifically focuses on this. Now, this is actually kind of important, right? And this is opposed to recreational, right? Recreational. Now, here's the thing. This is important for when you're pitching a company, right? If you say you focus on health and wellness, your investors understand that there's less risk, right? Recreational is coming, sure, but when, right? Health and wellness is here now. So if you're focusing on health and wellness, you're bound to succeed, right? If you pitch your company as purely recreational and then try to move into the health and wellness space, you're going to have trouble, right? So this move is not going to work. However, if you pitch it as health and wellness, and then you happen to jump into the recreational space, you will have a lot less trouble, right? Because you'll have an established name, an established brand, and one that has positive brand image, right? And so William Wrigley Jr. has invested in this startup, and it's actually very, very interesting. It's very interesting to see how this develops and where this goes. So that's the story on William Wrigley Jr. The next thing that we're seeing, and a lot of these are shorter tidbits because, one, we'll cover them in more depth in class. A lot of them take a very long time to explain in true depth, right, that does them justice. So we're covering them on the surface just so we're aware of what's going on in the world, right? This is pretty important. What's going on in the world, where things are happening, right? So blockchain companies, blockchain is merging. And this is seen often as a sign of legitimacy to new startups, right? So when new startups are coming out around the technology, in this case blockchain, right, which is the supporting technology for Bitcoin, and really the true innovation of Bitcoin, it's basically an automatic ledger, right? So rather than having to input every single time a transaction happens, it happens automatically, right? So blockchain companies are merging, which is a sign of legitimacy, but they're merging in particular in the fintech space, in the financial technology space. And this has really big repercussions, right? Because it adds more transparency, it adds more speed, it adds more accuracy to all of our financial trades, right? And this merger is a sign that the future is coming for blockchain, right? And that's something we're going to keep an eye on because that's a technology that we're going to see more and more leave the emerging space and enter the mature space, right? So that's something that we're going to have to keep an eye on, and for sure there's going to be quite a battle over who reigns supreme in that industry. All right. The next thing is an interesting article. It's about Apple suppliers, right? But basically Foxconn stock, and I forget if Foxconn is actually spelled with two X's. I believe it is. Foxconn stock, right, which is a major manufacturer of Apple components. They're the ones with that high suicide rate and so on and so forth. Foxconn stock is falling. And it's falling over a tweet from Trump. Now, the reason I picked up this article isn't because of the tweet or because the stock is falling. It's because of the link. Okay? The link is very important because what that says is there are investors with large amounts of capital that are following very flimsy pieces of information, right? I mean, Trump's tweet was Apple should bring home their manufacturing, right? I mean, we could talk about how ludicrous of an idea that is, right? Dave Chappelle does a good job in saying that $8,000 iPhones are not a good idea, right? And that people working in factories in the United States is probably not one of their desired job titles, right? So, but Foxconn falling means that investors are getting more and more short-term oriented, right? Which means capital is becoming abundant, right? Which means that we could be overheating if the Federal Reserve doesn't tighten capital fast enough, okay? So that's another indicator to look for, right? Whenever you see people making decisions, especially investment decisions with their money based on very flimsy pieces of information, that's probably a good sign that things might not be going as well as you thought they would. Okay, and then finally, developed currencies, and I'm not even going to write this out, but developed currencies are growing, right? So developed currencies are keeping up with the United States currency because they're all raising interest rates because they all basically did the same thing in 2008. They issued quantitative easing in one form or another. They increased the money supply, and now they're winding that down, right? So that's an expected thing, and I don't know why a full page was devoted to that, but I think that's something that we generally could have expected to happen knowing how we got there in the first place. Okay, so now we're going to cover September 12th. Okay, so in kind of philanthropy, which is another thing that's important to cover, right? JP Morgan Chase has committed $500 million to cities around America, and they'll have to fight over kind of who gets it, depending on the projects that they give them. But JP Morgan Chase has committed, and it's $250 million is available as a gift, and $250 million is available as loans. And these loans are lower interest loans, right? Now, what this tells you, perhaps, is that JP Morgan is trying to repair its image. That's probably good, right? You can speculate as to their reasoning, right? Perhaps they've had a very good year, and they need larger tax deductions, so they need to be investing, right? But this is the growing trend in finance, which is public-private partnership. And perhaps the growing trend in business as well, right? Is that private companies, right, even though they're not actually private because they're traded on the stock exchange, right? But private companies and public institutions are working more and more in tandem to deliver services and products, right? And some of the things that JP Morgan is trying to cover here is they want to address employment barriers. Employment barriers, right? They also want to address financial insecurity. And finally, they want to attribute or try to fix disinvestment in neighborhoods. Disinvestment. And what that means is some neighborhoods are starting to have falling real estate prices and falling involvement from their community. And the reason is the neighborhoods are losing money, right? So if your favorite store moves out of your neighborhood, that's not so bad. But that store employed 5 people. And if those 5 people can't go shop at another store, that's also going to fall apart, right? So if we're fixing employment barriers, that means we're looking at how do we get people to get employed faster. If we're fixing financial insecurity, we're saying, okay, how do we get people to retain their money, to save it, to use it in ways that provide financial security? And if we're starting to prevent disinvestment, we're doing something different. This is something that local governments have been doing very recently, which is they have been buying up things like strip malls that are becoming abandoned. And the reason is empty strip malls lead to higher crime. They lead to higher overall cost than just buying it in the first place, right? So a lot of these properties are now falling under government control, and the government needs financing to keep doing that, right? And that's where JP Morgan is trying to step in. Okay. Next. Steel tariffs. Steel tariffs. Okay, so steel tariffs are pretty interesting and pretty important, or tariffs in general, right? So we hear a lot of talk about tariffs. We hear a lot about what's going on with tariffs, what's not going on with tariffs. But overall, steel tariff have risen the price of steel. Risen price of steel, right? The price of steel. And the reason that's happened is if you can't import steel from foreign countries, you only have so much steel that you produce. And if you only produce so much steel, you have to charge higher prices. Right? And what that's done is that's also pushed up profit. Right? Because usually you're making a margin on what you're producing, right? So you're making 20%, 30%, whatever it is, but your input costs haven't really changed, even though the price of steel has risen. And so what it's led to is protests by steel workers, right? For higher wages, for increased wages. Now this comes at a good time when wages are increasing overall, so they may win this, right? But this is an important thing to consider for one reason, not because steel tariffs are going up or because that's bad or good or anything else. The reason this is important to consider is because tariffs have this effect across the economy, depending on what you put a tariff on, right? And so what ends up happening here is if the protests do end up increasing wages, and then the tariff goes away, we are left in a worse competitive position globally than we were before, right? Because we are now able to produce steel for more money than we were before, right? So it's important to consider the long-term ramifications of tariffs and the things that adjust with the tariffs besides just the price, right? So when thinking about tariffs, always try to consider, okay, how else is this going to ripple through the economy? Let me see if I can read the chat. Looks like there's a question. What if those steel tariffs get canceled? There you go, right? I just answered your question. If the steel tariffs get canceled, nobody's going to say like, oh, hey, steel prices are lower now, I'd like a lower wage, right? That's not going to happen, right? Instead, what's going to happen is we'll just be less competitive, right? So tariffs have long-term ramifications and ones that you should be thinking about. Okay, so China is continuing to court U.S. investors. Now, there was much speculation about whether or not this would happen. Most of the speculation relied about the fact that they could, in a retaliatory stance to our tariffs, decide that they're not going to do this anymore, right? But they've continued to do this. And the reason they've continued to do this is because they need funding, right? That's just the reality, and that's going to stay the case, right? Because of a flight of capital. Now, a little bit more worrying is that Russia and China are conducting joint military operations. Or in this case, it was a joint military parade or demonstration or whatever you want to call it, right? They conducted a joint military parade. Now, this is worrying for the following reason. I don't think this is the source of World War III. Right, but I do think this is the source of China's funding independence, right? And if China becomes funding independent, that is a big deal for China and a big deal for the United States, right? And the reason is Russia has an extremely high amount of natural resources and land, right? What they don't have, or what they also have, is a declining population, right? So if the two do get together, it's like a match made in heaven. However, right, we're talking about two people that run these countries, right, that are both called presidents for no good reason, right? They're just called presidents, but they're really oligarchs. Or, excuse me, they're really monarchs, right? They're really monarchs in their nation because, the Chinese president no longer has to go through elections, and Putin, I don't think, has ever gone through a fair election. So the reality is, it's very, very difficult for them to do this, right? The next thing, just recapping a story that we did before. So Google is fighting this idea to be forgotten, right? Google forgotten, right? So the fact that you can eliminate yourself off of the web, right? And the reason they're fighting it is because you can only eliminate yourself in the country in which you have jurisdiction, right? So for example, if you live in France and you don't want to be in France's search results, you can eliminate yourself there. However, if someone in France uses a VPN, they can still see you. If someone in the USA sees you or looks you up, they can still see you. And the reason Google is fighting this is because it's very difficult, right? It's very difficult for them to figure out where jurisdiction ends and begins, and they don't want to be the ones responsible for that, because then they're stuck between a rock and a hard place. And actually, they have support from major EU governments on this. And this is a new development as of today, right? But there are major powers, EU, there are major powers that are now interested in this happening as well, because it does lead to quite a messy situation, and it's understandable that Google doesn't want to get involved, right? Just a quick note, returning to developing nations, Hong Kong is now considered to be in a bear market. Right? Hong Kong is now in a bear market, which means they've just had some distance of, or some time of declines. Right? So they're considered to be in a bear market, which is not a great thing, because Hong Kong tends to be a pretty stable market, and one that tends to precede on most problems developing nations. Right? So Hong Kong is now officially considered a bear market, which leads to our kind of understanding that maybe overall things are not going as well as we thought, right? That's pretty important. Now, when we move to the next piece, we're moving to something interesting that's happening in medicine, right? So last time we talked about how pharmaceutical companies are being sidestepped by these mass pharmacy producers and what that could mean for our economy, right? And furthermore, what we're seeing is more privatization and, importantly, specialization. And the reason this comes up today is because OneOncology has received a $200 million investment to build these specialty cancer treatment and management facilities. They do nothing else. They don't care about your heart problems. They don't care about if your leg hurts. They only deal with cancer treatment, right? And we've been seeing this trend happen quite a bit, right? There's all these emergency clinics popping up. There's all these special disease management clinics popping up, right? And so if this is a continuing trend, we're going to see a greater disaggregation in specialized care, right? And that's probably not a bad thing, right? Because you used to have to go to 7 different doctors for cancer, right? Your doctor does diagnosing, your doctor does pain management, and so on and so forth, and now you can go to one location. And that's kind of the idea, right? Is that we're consolidating the doctor model, right? So we're consolidating doctors, but we're disaggregating hospitals. Hospitals. And we fall somewhere in the middle over here, right? So doctors are joining together to create these kind of more fluid and more specialized institutions. Okay. Next, and this is generally something that we should be watching, right? Is automation. Right? Automation is coming, whether you like it or not. Well, to be fair, it's already here in a lot of ways, but it's coming and it's going to dominate the market in more and more ways. Basically, every week, every month, whatever time space you want to call, it's going to be happening, right? So computer vision is improving. Right? Partially because of the push by self-driving cars and kind of all of that innovation, but it's now being used in the food industry, right? And this particular example, and you should try to understand kind of the scale of this, right? Is this particular company makes sausages, right? And when you fill a sausage, the sausage will have links in between, right? Now with computer vision, right, you have to cut the links, right, in order to make individual sausages. With computer vision, you're able to do this at 200 links per minute. This is insane in terms of scaling your production, right? The only thing really holding back production now is people, right? If we look at it from the current perspective, right, you can move things very fast down a belt, you can move things around, you can track them, you can do a lot of different things, but people still kind of slow down the process, because, I mean, how fast can a person really chop sausage links, right? But 200 per minute is pretty big, and that number is only going to rise. That number is only going to increase and is only going to spread to more industries, right? So the other thing that this is doing, in the large part, is quality assurance, right? So quality will be increasing because things like microwave pizzas and so on and so forth are currently inspected by humans, which is great. But when they're inspected by machines, they're going to have a much smaller failure rate and a much smaller rate of error, as well as being able to do it faster, right? So it's just a win across the board. Next. Oh, finally, the SEC, this is the last article of the day. The SEC is policing cryptocurrency. It's policing crypto, right? So this was kind of a big victory overall. There's three pieces to this victory. The SEC is looking into price manipulation and ways of preventing it or ensuring that it doesn't happen, or at least the ability to catch people doing it, right? Which is going to be pretty difficult, but it's good that they're trying. The second thing, they're looking at illegal hedge funds and illegal investment funds. Right? These are companies not registered with the SEC that are gathering investment dollars and perhaps lying about being regulated funds. And then finally, it's been ruled that ICOs, or initial coin offerings, are now jurisdiction of securities fraud. Of security fraud. And what ICOs were, and this is a lot of startups tried to do this, right, is they would basically release a coin, a digital currency that they would make up, and that ICO would give you some rights, some abilities on the platform, some ownership of the company. It was basically like IPOing before you actually had a finished product. And what ended up happening is a lot of people took the money and ran, right? And so investors got pretty upset, and so now ICOs are running into a problem. Okay. Let's see if there are any more questions. Do you have any money in crypto? No, I don't personally. I don't personally have any money in crypto. I didn't jump on the bandwagon, so to speak. I was very interested in cryptocurrency when Bitcoin was basically worthless. I did think there was a lot of potential for the future. I didn't understand enough at the time to invest, and so I didn't put any of my money into it. I think blockchain is much more the future. I think crypto is going to happen very differently than how it's happening now, but I stayed away from it for the sole reason that price manipulation is never a good thing to get involved in, no matter how much money you're making, because it's just not good, right? It's just not a good thing to be invested in. It's not a good thing to worry about. It's not a good thing to have to look over your shoulder all the time. And there was rampant price manipulation in Bitcoin, especially over the last 2 or 3 years. So to answer your question, no, I have no investments in cryptocurrency, and I have none pending at this time. I do think that we're going to see private companies that are already publicly listed start releasing cryptocurrencies, things like JP Morgan Chase and Citibank. And then maybe you can receive your money in cryptocurrency. So we'll see some innovation there, and I'll actually we'll do probably in economic history. We'll actually cover things like cryptocurrencies and stuff like that, because although the implementation is new, the idea and the fundamental way that it functions is really not. Okay.